Good morning, ladies and gentlemen, and welcome to the F&C Investment Trust full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit the following poll. Be most grateful if you could give that your kind attention. And I'd now like to hand over to Christine Cantrell, Director, Head of Investment Trusts. Good morning.
Thanks, Mark, and we're delighted to be here. It's the first time presenting in this forum, and F&C Investment Trust is the flagship investment trust of BMO Global Asset Management, now part of Columbia Threadneedle, with over £5 billion worth of assets under management and having been run for over 150 years. So I'm thrilled to get some feedback from you and also questions at the end, which I'll then pose to Paul on your behalf. So thanks very much, and I'll hand over to Paul now.
Great. Good morning, everyone, and thanks very much for attending. I'm going to run through three broad areas this morning. Firstly, a bit of an introduction to the trust for those that are less familiar in terms of how we manage the underlying assets portfolio. I'm then going to move on to 2021 results and give you an overview of our performance, key drivers, and then I'll move on to discuss the outlook. So there's a lot to get through, and I'm going to just switch off my camera so that you have full sight of the slides, and I'll come back on screen at the end to obviously answer any questions which you may have. So let me start very briefly with a little bit of an overview of the trust. As Christine said, we have been around for over 150 years. It is the world's oldest investment trust, predating mutual funds by around 50 years. We've paid a dividend every single year since launch back in 1868, and prior to this year we paid 50 years of consecutive dividend rises, and we are proposing actually our 51st for 2021. There's been a high level of consistency in terms of management of the underlying portfolio. Only 11 managers over the last 150 years. I'm the third manager since 1969, and I took over responsibility for the trust in mid-2014. It's very much a growth-focused trust. That has been the case since the mid-1960s. In fact, one can go all the way back to the 1920s when we made our first investments into equities. One of those investments was Shell, which we still hold today. And we've also been investing in private markets for a very long time. Now, one of the unique features of our advantages of investment trusts is that they have a closed-ended structure. It means that we can take a very long-term perspective and essentially buy illiquid assets. And investment in private markets is something that the trust has been doing for a very long time. And I'll talk about how we approach that today, because we do have investments in unlisted private equity as well as listed equities, and we've got scale. So our market cap, and this is at the end of January, was in excess of 4.5 billion, net assets of 5 billion. Obviously, the numbers have come down somewhat since then. Moving on, just a brief overview. There's a lot of information on this slide, but the way that we approach portfolio management is to allocate capital across a range of different underlying strategies. And this shows the picture again at the end of January. So you'll see there's a range of regional strategies and a range of global strategies. And we're investing in the listed space directly. So essentially, we appoint managers from within BMO or from across the market to select underlying stocks within a clearly defined mandate. So for example, you can see at the top here, we've got US growth, 15.7% of the portfolio. That manager holds 67 stocks, and that's managed by T. Rowe Price. Now, other components are managed either by BMO Global Asset Management or indeed affiliates like LGM and Purford. So a range of different underlying strategies in the listed space. We also have a range of exposures within private equity, where we invest into both funds, but also co-investments. And co-investments are essentially direct stakes in unlisted companies, whereas funds obviously pool across a range of different underlying holdings. Now, the vast majority of that private equity exposure is unlisted and very long-term in nature. And typically when one buys one of those unlisted private equity funds, we're looking at a 10+ year life. In fact, maybe a 12 to 15-year life is actually more realistic. So a very long-term commitment of capital in the private equity space. And you can see there at the end of 2021, we had in aggregate about 10% within private equity. Those fund-to-fund investments, for those that have followed the trust for longer, those are historic commitments, old commitments that were made quite some time ago, and they're diminishing and will head towards zero in coming years. So we've been making a number of fund and co-investment commitments in recent years. Now, the purpose of this approach, we're a generalist trust, and that means that we do not have an out-and-out growth or value bias. To take two examples of how one might approach investment in equity markets, but you can see here, somewhat stylistically, by adding the risk of each of those individual strategies, how you end up with an aggregate risk number all the way to the right. But the point of investing across a range of different strategies, all of which do something slightly different on the portfolio in terms of where and how they invest, leads to a compression in risk. So essentially, returns can be additive, but risk is not. And what, again, to play that back slightly differently, by investing across a range of different strategies, we expect a smoother outcome for investors rather than investing all of our capital in one particular style or manner of investing. And I'll get into talk about growth and value as we go through the presentation, but that's obviously front and center of investors' minds right now. Just briefly on performance, there is a variety of performance numbers in the pack, and I've just picked here the performance outcomes since I took responsibility for the portfolio. On the left-hand side there, you can see left to right, i.e. median. That's basically global equity open-ended funds, so OEICs, which are open-ended. We've got the Vanguard ETF, which is a passive fund. Then we've got a market benchmark, which is our benchmark, FTSE All World Global Equity Benchmark. And then the two bars at the right are essentially FCIT's performance outcome in underlying NAV terms, what's happened in terms of underlying asset growth at the portfolio level, and what's happened in terms of share price total return. And I've compared both those numbers to the AIC median, which is basically the closed-ended or investment trust equity sector comparators. So I think the message I'd like to convey here is that our performance has been clearly very strong in absolute terms. It's been a very favorable environment for investors in equities over the last few years, but we've also delivered very good returns, I think, against various comparators, whether they are closed-ended, open-ended, and also against the market benchmark. Now, I would say in the last year or so that we have seen a disappointing trend in terms of our discount. We had actually reached the point, you can see, actually towards the end of 2018 and through 2019, we were issuing shares, we were trading at a premium, and there'd been a journey in there from what had been a quite persistent discount prior to 2014. And in the last couple of years, really since the pandemic hit in the early part of 2020, we saw our discount widen, and it has not recovered as yet. And obviously, greater risk aversion in the market in the last few weeks has exacerbated this trend, such that we're trading actually wider than where we ended 2021. So performance, I think, is good. Discount has been somewhat disappointing in the last couple of years, having been on a very positive trend. Now, let me just move on to the 2021 results, and I'm sure they've got a number of shareholders on the line. So I'm going to give you a sense about what the highlights were and some of the key drivers of performance over the course of that 12-month period. So we delivered a shareholder total return of 19.4%. NAV total return was better still at 21.7%, and the benchmark, that's the FTSE All World Index, which is a global equity benchmark, returned 19.5%. We saw a widening in discount from 5.4% at the start of the year to 7.3% at the end, and that widening obviously led to a reduction in return for shareholders, and that's the reason why there's a little over a 2% gap between underlying asset growth and the return to shareholders of the 21.7 against 19.4. In response to widening of our discount, we bought back 9.9 million shares. The reason that we undertake buybacks is that buying back at a discount to NAV is accretive in terms of enhancing the NAV return, and we do think that it's appropriate, and the board are committed to undertake buybacks in normal market conditions where the discount is unreasonably wide. Net revenue return per share, we obviously had a challenging period in 2020, but there was a good recovery in terms of underlying revenue, which grew by 13.2% on the year to just under 11 pence per share. And that led the board to propose a 5.8% rise in dividends for 2021, 12.8 pence dividend per share. And repeating the point I made earlier on, we paid a dividend every single year since we launched back in 1868, and this will be the 51st consecutive annual increase. I'll give you the detail in a moment, but one of the highlights from last year was really the returns on our private equity exposure. They materially exceeded listed market returns. And again, reflecting on what I said a few moments ago, we've got some older commitments, somewhat historic in nature, and newer commitments. And those newer commitments really delivered a very pleasing return on the year. We saw a year where interest rates rose relatively materially in terms of bond markets, and that reduced the value of our outstanding debt. So as a trust, we can borrow to invest, and we do have longer dated borrowings, and essentially we mark those to market. And what that means is that when interest rates in the market are rising, it reduces the value of that outstanding debt, and that was beneficial last year, adding 0.6% to overall returns from a NAV perspective. Our charges reduced down to 0.54%, and I'll get into a little bit more detail on that. But essentially, we've the management fees on the products have been cut for 2022, and they will fall further in 2023. And importantly, the last point on this slide is that we made good progress on our ESG agenda. We did make a commitment, the board made a commitment to be net zero in the underlying portfolio by 2050 at the latest, and there's been enhanced reporting and progress towards that objective. And we have undertaken selected exclusions on the portfolio. So just briefly adding a little bit more colour to that in terms of the value bridge to get to that overall shareholder return of 19.4% on the right-hand side there, which you can see compares to the pretty much in line with the benchmark total return for the year. Just running through left to right, underlying portfolio 19.2% return. Gearing in a rising market, gearing was additive to returns. We ended the year with 9.4% gearing at the portfolio on the portfolio. That added 2.5%. We undertook buybacks. I said 9.9 million shares bought back on the year. That added 0.1%. Because interest rates rose, as I said, that added because the value of the debt outstanding that we had issued reduced, and that was helpful. And then we had fees, management fees, and interest and other expenses, and those obviously detracted from overall returns. So you add those components together, and you can see that we delivered a NAV total return of 21.7%. Rise in discount led to a shareholder total return of 19.4%. In a bit more detail, this shows you the direct allocation to different parts of the portfolio. So reflecting on the slide I showed you right up front as to the different components of the portfolio that we have, you can see that we had 40.6% allocated to North America. But the underlying allocation, and what I mean by that is when we take all of the underlying components, whether they're allocated directly or through a global strategy or through private equity, the underlying geographic exposure to North America was actually 57.8%. Benchmark weighting, that's going back to the FTSE All World, 62.4. And then we've got the portfolio performance, what that direct allocation delivered against the index. So in the case of North America, it was a year of underperformance, unfortunately, 23.7% against the index of 27.6. Now, and you can read through for each of those lines, and I'll draw out some of the highlights from this. Now, I said previously that we have a range of underlying strategies. We've got a growth manager, we've got a value manager in the US. Both areas delivered very strong returns in excess of 20%, but we saw underperformance from our growth manager, T. Rowe Price, last year. They delivered a return of 20.9%, which was quite far behind actually the growth index, while our value manager delivered a return of 26.5, ahead of value comparators. And we also run a component within the portfolio where the BMO run internally, which has got a little bit of a value bias, and that delivered a return of 36.4, and actually was the highest absolute gain of any component of the listed strategy. So you add that all together in terms of North America, and due to the underperformance from growth, unfortunately, we lagged in that area. Europe, we also we're slightly behind benchmark, just under 14% against 17. Japan and emerging markets, both areas in a broader context of quite anemic growth, 2.6 and 3.8% delivered on the portfolio, but both areas delivering excess returns against benchmark comparators, albeit relatively smaller compared to the holdings that we have in North America and Europe. And then moving down, in the global space, we have an income strategy. That income strategy, buying stocks which basically have a yield in excess of the market. Again, something of a value bias on it. So you're buying stocks that are cheaper than the market. That had a really very, very strong year, up by 30.7%. But there was a really, as elsewhere in the portfolio, a really wide range of returns within global strategies. Small cap, we have some small cap stocks in there. They delivered 11.7%. And a sustainable or ESG focused strategy was also slightly behind at 16.8%. So again, you add those components together, and global strategies were just slightly behind that broad benchmark return. So listed market exposure, I would say it was a bit of a mixed bag. Very strong performance from value, very strong performance from income, some other very good returns from emerging markets, and Japan was also slightly behind. But it was really growth, small caps, our sustainable strategies, and also Europe where we struggled. But private equity was an area of very good levels of return, 30.1%, which is more than 10% ahead of listed markets. And I'll get into some of the drivers of that in a moment. But it's very pleasing to see that level of return from private equity. And we do, as an aside, aim to have between 5 and 15% of the portfolio in private equity assets. So that 10% allocation is around the middle of that range and in line with where we want to be. So moving on, I just want to give you a bit of a sense of what we actually did in terms of allocation changes on the year. And what this shows, again, is the primary components of the portfolio in terms of strategies, each of which, is allocated to a manager who picks underlying stocks, and what the changes were on the year. And there's a few points of significance I would point out. We came into 2020, which is the dark blue bar here, across each of these areas, with a very high weighting towards US growth stocks. And contrast that with US value, which is Barrow Hanley, who run that US value component for us. So we're just under 25% in US growth, and we had around about 13% or thereabouts in US value. So for those two components, it was broadly 2/3 growth, 1/3 value. From the early part of last year, we started divesting out of US growth. So, those are the managers got heavy exposure to names like, Amazon, Facebook, and so on. High growth, highly rated, fast growing companies that had performed fantastically well. And actually that trend of reduction of exposure to US large cap growth carried on a trend that we started in the second half of 2020. So it was a continuation of that trend. So at the end of the year, which is the lighter blue bars there, you can see that the exposure would leveled up broadly, the exposure between growth and value in the US. And actually, year to date, we've gone further. In the early part of the year, we moved more out of large cap US growth, and US large cap growth has been underperforming year to date, as I'm sure you are aware. We allocated more to that US core strategy that I said had a fantastic 2021, also has a little bit of a value bias to it. We reduced emerging markets in the earlier part of the year. Emerging markets, as I said, were a pretty disappointing area for performance. We allocated more to global income. You can see just over halfway along the chart here. Looking again to access more by way of stocks with the yield pickup, and again, cheaper areas of the market with more cyclicality. And private equity, we made good progress towards that 10% allocation at the end of the year. So a little bit more detail on private equity. We saw, as I said, very strong returns overall in 2021. 30.1% for the full year, and that continued to a long-term track record of delivering good excess returns against public market equivalents, and public market equivalents are basically listed equities. We saw good returns from those older holdings, those fund of fund investments that some of you who are long-standing shareholders may recall that the trust invested in back in between 2003 and 2008. There was a program of investment with those two managers. So return there, again, it was ahead of listed markets, 23.1%, but good cash flow coming back. As I said, we're realizing cash from that area of the market, or that area of the portfolio, I should say, and over time we'll expect that allocation to diminish. Our recent commitments that we started making several years ago through BMO, predominantly using the internal private equity team within BMO to help us select attractive fund and co-investments, that gained by 39.2% on the year. We saw quite a significant uplift in value from a number of holdings, one of which to call out is one called Inflection Strategic Partners. That was written up by almost 50% on the year, and that basically is actually a holding in the economics of a third-party private equity firm. So it puts us the other side of that private equity trade. Obviously, private equity firms are attractive from the perspective of they have not only high levels of fees, but they have the successful managers, of which Inflection certainly is one, have a high level of persistence of fee income. And obviously very long-term mandates. So there was, due to very strong operational performance, that holding was written up materially over the course of the year. We've got a couple of holdings within we class as private equity, but you might be familiar with, they're actually a couple of investment trusts. So they're closed-ended funds which trade on the listed market, but they invest into unlisted holdings at the underlying level. In the case of Syncona, that's life sciences. In the case of Scalian, that is a disruptive technology, later stage pre-IPO investments. And Syncona struggled last year. The premium declined materially. It declined. The holding declined by 18.8% in the year. Whereas Scalian, where we took a C share issue during the year, that gained by 30%, so that was a strong return. We made some new commitments to BMO, and that's part of this long-term program that we have of maintaining private equity exposure. And again, those that have followed the trust will be aware that in the prior year, 2020, we made a $180 million commitment to Pantheon in a new program to invest into the top tier hard to access, excuse me, leading growth and venture funds. And at the end of the year, we had just over £50 million worth of NAV in that strategy. It's very, very early days for that strategy, given the level, the time frame attached to those commitments. But nonetheless, it's good to see progress there. So a very good year for private equity. Really good progress in most areas. Just on the dividend. The headline I've given you already, up by 5.8% is the proposal, 12.8 pence for the year. There's a small increase in special dividends that we received from underlying holdings. Our FX movements were negative of £4 million on the year. An important point I would make is that it was pleasing to see a rise in net revenue per share. The dividend, however, does remain uncovered. We have undertaken extensive modelling as to expectations for the future, but we do have very healthy levels of revenue reserves of 17.8 pence per share, which is £93.8 million as at the end of 2021, and that is before the payment of those third and final dividends. Now you compare that revenue reserve per share of 17.8 pence to the dividend of 12.8 pence, and you can see that we're in a relatively comfortable position, I think, in terms of being able to not only continue to pay dividends, which we will fund from ongoing revenue receipts, but if required, then we do have that revenue reserves, and I'm not suggesting we will get to this point, but we have very, very substantial capital reserves were they to be required. So the board are committed to raising dividends for shareholders over the longer term. Gearing. There's quite a lot of information on this slide. What I would say here is we've got very, very low costs of gearing. We ended 2021 with £550 million of gross debt. That was 9.4% gearing levels at the portfolio level. Blended borrowing costs 2.2%. Borrowing costs are very, very low. We undertook one issue during the year. The rates are outlined, and you can see that was £140 million with borrowings out to 2056 with a rate of 2.33%, and we agreed to borrow a further £140 million, which we've drawn actually just at the beginning of this month, and those rates were extremely attractive. So the trust has now got borrowings out to 2061, and that borrowing out to 2061 was secured at 1.87%. Very, very attractive rates of borrowing. If you look at the gilt yields today for a 40-year government borrowing, UK government borrowing, are 1.6%. So we locked in at 1.87, and if we can make an excess return above, or a return, sorry, I should say, above 1.87% over that longer time period, then it's going to be accretive to returns for shareholders in NAV terms. So we thought it was a very good time to lock in those longer term rates. We've got some short-term borrowings which are drawn, 50 million right now, and also some debt which is coming due in July. So you add those two components together, and that's £120 million approximately. So we'll use some of that recent drawing essentially to refinance shorter and maturing debt. Just on charges have come down. This gives a bit of a longer term perspective. We ended the year at a 0.54 ongoing charge for the trust, which is good progress. And the management company BMO have agreed to with the board to reduce management fees further. So we get incentivized and paid on market capitalization of the company. So our interests are aligned with those of the shareholders, and we've cut. There's a tiering. There's tiering in terms of fees, which is outlined in the slide here. So anything above 4 billion is 25 basis points, and then there's levels below that. Basically, at the lower level, the fee has been cut from 0.35 to 0.325, and from next year, that lower tier will be removed altogether. So again, good progress on fees. Just a few words on sustainability and ESG, which I know is a very big area of focus for a lot of our shareholders. We have, in recent years, I think, made really good progress in terms of reporting to shareholders what we're doing in terms of underlying engagement with the companies which we invest in. There is a sense of, well, there's much more detail in our annual report and accounts. We vote stocks, we raise issues with companies through engagement, and it was noteworthy, I think, and again, more detail in the annual report, that climate change is gone further up the agenda in terms of engagement. That's consistent with our path to net zero, and climate change represented 22% of engagement activity, up from 16% the prior year. We also report the carbon intensity of the portfolio and against the benchmark, and we've done that for a number of years, represented in the bottom right hand side of the slide here. And you can see that the benchmark had a broadly flat outcome in terms of carbon intensity. Our exposure actually in terms of carbon on underlying holdings did rise on the year. That was a function of this move more towards cyclicality and value, but the long-term trend clearly is one of seeking to deliver on that net zero target. And on that point, I'll just make a couple of additional comments, which is that we are now measuring and reporting on how underlying companies that we invest in on your behalf are aligned or aligning to a net zero objective. And our intention is to work with companies through engagement to ensure that we have a common view in terms of getting to that net zero target. And finally, just on sustainability, we also report more detail in the annual report on the alignment of the portfolio to sustainable development goals. Again, that's a focus, I think, for many investors. Now, I'm just going to rattle through a couple of additional slides, and then I'm going to make a few comments on where we are and where what we think in terms of the outlook. Just very briefly, this is the overall look-through exposure of the portfolio, again referencing what I said there on about pulling all those holdings that we have and thinking about where they are geographically, and in the listed space where we're invested on a sectoral basis. And you can see that over 50% of the portfolios in North America. The next largest area is Europe. We've still got a large component of the portfolio in technology, albeit we've been moving out of the large cap tech space and those more highly valued technology stocks. Just in terms of performance, I gave you some performance stats earlier on. I draw your attention just to the NAV return here, which is over the last 10 years is 14% per annum. Obviously, a great outcome for shareholders over the longer term. Equity market's been very strong, but really consistency. We're a generalist trust, so we look to provide a smoother performance outcome than one may see in portfolios which are much more focused on one particular way or style of investing, and therefore consistency in terms of return against peers and benchmark is something that we seek to deliver on. So that was to some extent the easy part, in the sense of that is where we are and what has happened in terms of 2021. I'll make a few comments just in terms of the backdrop, where we are and where we possibly might be heading in terms of markets. I'd preface all of these comments with the statement that clearly we, as I'm sure you are very cognizant of, the historically significant events in Ukraine, the huge humanitarian and human cost that this is placing on civilians and military in that area, and the events are extremely fluid and also very fast moving. So in the sense that if we'd had this conversation just a few weeks ago, I think many of the key messages would have been markedly different, but things have moved on very, very materially, and not in a positive way, and markets have obviously responded accordingly. So let me just run through a few slides. Now, what I would say at outset is while these slides are up to date in terms of the data which goes into them in most instances, so that the data on this slide is from the 8th of March, we're yet to see the full ramifications of the conflict in terms of push through to inflation and also growth expectations. And on those 2 points, then clearly we're looking at a worse growth outturn globally than what we were looking at a few weeks ago. And we're looking at higher inflation than what we would have been expecting a few weeks ago. We were expecting that growth in all major areas in the developed space would have been above trend in 2022. And post the invasion, we see the US as much better insulated from what's going on in terms of rising commodity prices. Eurozone much more exposed, clearly, and the UK also relatively exposed to what is happening in terms of energy costs. But Eurozone is the obvious area which is likely to get hit hardest. Now, putting some numbers on this is extremely difficult at the present time. What I would say is it is entirely possible and indeed probable that we may well be seeing some negative quarterly growth readings coming through from Europe and the UK in coming quarters. So it is possible that we may see a technical recession, particularly in the Eurozone, as we move through 2022. And that is not a view that we would have held just a couple of weeks ago. The other point I'd make is that people, and us included, were actually hoping that Europe might deliver better growth than the US this year. There's virtually no chance that will be the case this year, given again what's happened. And in fact, previously one may have hoped that Europe would deliver something like 3.5% to 4% overall GDP growth. It's likely to be closer to 1% to 2%. So there's quite a marked downturn in terms of growth expectations in the Eurozone in particular. And this downgrading growth expectations, upgrading in inflation expectations, and obviously we saw inflation in the US hit 7.9% yesterday, and that was before the impact of the recent spike in commodity prices. This creates quite a troubling backdrop in terms of how central banks respond to rising inflation and also deteriorating growth. One positive I would say, however, amidst all the uncertainty, is that we call these COVID piggy banks. Basically, there's been a significant rise in savings from consumers in the US, UK, and the Eurozone. You can see here through the pandemic, people have spent less, saved more, and this means that they may be somewhat better insulated from some of the shock which is about to hit in terms of inflation and consumer confidence, I should say. Again, look, I've got the consensus inflation numbers here for the UK, US, Europe, and also Japan. Japan's quite noteworthy in the sense it's been very, very anemic in terms of upgrades to expectations. The market is somewhat, in terms of consensus, behind the curve in terms of where these numbers are going to get to. It is entirely possible that as we move through the year, that inflation in the UK could be hitting something around the 8% level as we move through to April, and maybe through to October, where we see the price cap on energy lifted. And as I said, in the US, we saw a number of 7.9% yesterday. So really quite troubling signs in terms of inflation. The one positive is that as we move through the year, that base effects become more positive. What that means is, that in order to get continuing rises in inflation, one needs to see sequential rises in prices. And because there'd been quite a rise in inflation last year, base effects means that that's going to be a bit of a drag to some of these inflation rates as we move through the next few months. But it's obviously a pretty challenging environment for inflation. And when one looks at what the market's pricing in now, this is quite a complex chart in terms of how it's calculated. But in simple terms, this is the long run market expectation for inflation in the US. So the market in the US is now on for the next 10 years saying that inflation is going to be around about 2.7%. That is the highest that it's been certainly for the last decade, and the highest since this series is available. It's still relatively low in absolute terms and not as high clearly as some of the headlines that are coming through short term, but it's quite a material uplift. And this is consistent with our view that we thought post-pandemic there was going to be a structural rise in inflation. But again, putting it in context, the market is expecting that inflation will be less than 3% per annum over the next 10 years, and that some of these moves that we're seeing, not just in commodities but more widespread, are somewhat transitory in nature, and that's a risk clearly. Interest rate expectations, just very briefly on this. This looks in Europe and the US and the UK about what the market is expecting in terms of policy rates 1 year forward, and there've been a steady upward march in terms of interest rate expectations because growth had looked robust, inflation was heading higher, central banks had signaled tightening to come. But the last couple of weeks have seen, in most areas, the US were still expecting, the market's still expecting around 1.75% interest rates at the end of the year. But there's been something of a reassessment of just how far and how fast interest rates are going to go up. This again, some of you will be familiar with inflation-linked bonds and index-linked gilts in the UK. This is the TIPS market, which is from the US. Now, what's been going on in recent years, in general terms, has been a collapse in real yields. So this basically is taking bond yields, government bond yields, and adjusting for those inflation expectations. So essentially, you take the bond market, you look at what interest rates are further out the curve, and then you take off expected inflation. And interest rates have been negative in real terms for the last few years, and that is a tremendous support to equity markets, because you buy equity markets, what you're buying is expectations of a future stream of dividends or cash flow. And essentially, if you use a discount rate, then lower discount rate, all else being equal, means that you pay more for equities. So low discount rates, low real yields have been supportive for equity markets. And the trend prior to a couple of weeks ago had been that real yields still negative, but they were heading higher because growth was robust, inflation was rising, central banks were going to be tightening. And what we've seen is that real yields have actually come back down quite materially. The other point on the growth value trade, which again I'm sure many of you are familiar with, is that I would argue, and many others I think would concur, that growth stocks, highly valued, fast-growing equities, again like Amazon, Facebook, and so on, have been supported by very low real yields because they are longer duration. They're more expensive. More of the profits are in the future, and that rise in real yields was unhelpful. That's somewhat reversed and makes it a somewhat more, not necessarily challenging picture, but certainly a more balanced picture in terms of what that means actually in terms of the growth value trade. On balance, however, and there's a lot of information on this chart, or these two charts, so I do apologize for that. Key message on the left-hand side is basically when central banks tighten, real yields tend to rise, at least based on history. So I think on balance, actually, real yields probably going to rise. That means growth stocks probably remain under some pressure, at least in the short term. And the other point is there's tremendous distortions affecting bond markets at present. Bond yields are abnormally low. They probably should be higher when one looks at growth rates and inflation, but central bank buying has depressed yields very, very materially, and that's going to be ending relatively soon. So rattling through a few final slides before I pause and open for questions. This just looks at what happened last year, right? So you can see the orange, bars there show that there was a reduction in the multiples across all equity areas last year, but the blue line, or the blue bar, earnings growth, that was much greater than the derating in markets. So last year you saw rising bond yields, lower multiples in markets, but very strong earnings growth. When real yields are rising and yields are rising and central banks are tightening, then you tend to pay less for equities. And again, we've seen that this year. The question is, to what extent earnings growth is going to offset what is likely to be an ongoing reduction in market multiples. The multiples are high compared to history. We can't get away from that. They're slightly out of date. I don't think the picture changed that materially, but this shows the NASDAQ, which is obviously US technology stocks, US and global ex-US. And there's a big gap between the US and the rest of the world, and the NASDAQ continues to trade expensive. On this point about the trade-off between lower multiples and reasonable earnings growth, the expectations are still that earnings are going to grow by 7 or 8% in the US this year. There may be maybe some modest downgrading of that, but unless we see a more pronounced economic downturn, I think that we will get a reasonable earnings outturn, certainly in the US this year. And again, that is helpful in terms of offsetting some of that multiple compression. I am going to make one final point, which is on the value growth trade. And this just shows the price relative of growth against value in recent years, which is the red line there, and what the earnings relative is. And the point is, in recent years, you've had better earnings growth from growth stocks, fast-growing growth stocks, not surprised, but you've paid an increasing premium for those growth stocks. And this is not completely up to date, this slide, but again, the picture's not changed that much. There's quite a big gap there, and I sense there remains some vulnerability. And again, that is one of the reasons we felt there was going to be more of a positive macro backdrop from inflation, interest rate perspective, and growth perspective for value over growth. So we've been selling out of some of those large cap growth stocks. The environment now, which looks a little bit more stagflationary, without overstating that point, is a little bit more nuanced, I would say. So we're pretty balanced in terms of exposure between those areas, but very mindful of that large gap in terms of historic premium that one is paying for growth stocks. Now, I'm going to pause there. I'm very happy to pass back to Christine and open for. Thanks for your attention.
That's great. That's great. Christine, perhaps if I just give you a few moments. Can I just please remind, ladies and gentlemen, you can continue to submit your questions using the Q&A tab on the right-hand corner of your screen. But just while Christine and Paul take a few moments to review questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Christine, if I may hand back to you just to manage through the Q&A, and of course, I'll pick up from you at the end before asking investors for their feedback.
Great. Thanks, Mark. And thanks, Paul, for enlightening us about all the markets, which is very difficult at the moment. So one question, and I'm going through first some of the pre-submitted questions because it's only fair since people sent those in a few days ago. One is regarding the changes to the portfolio in light of the war of Ukraine. Now, I know you focused there on kind of your changing view of Europe and maybe even on growth stocks, but is it too short-term an attitude to say you're making changes to what's happening in Ukraine?
Yeah, I think there's several aspects to this. Things have moved very, 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 very fast, and clearly the backdrop looks very significantly different than what we would have assumed a few weeks ago. On the direct exposure to Russia, we had 0.3% of the portfolio in Russian securities at the end of the year. We made steps to reduce that exposure after the invasion, but markets are essentially shut now. So the holdings that we have there have been written to zero. In fact, market index providers removed Russian stocks at zero. Beyond that, there's a few things that we have done. We have raised cash, which we'd started to do and the effect of that is essentially some modest reduction in gearing. We had a long sterling position on, or have a long sterling position on, which is through a forward contract, and we've reduced that somewhat as well. And so we've got a very small portion of the portfolio actually in sterling assets. We've also got sterling borrowings. But if there's a much more significant risk-off event, then sterling would tend to decline against the dollar, and we're very mindful of that possible eventuality. So we took off some of that long sterling position, which basically pushes us back longer dollar, and that's a bit of a hedge against a bigger risk-off move. We also reversed out some of our European equity position as well, actually, for the reasons that I outlined, in terms of that being the area that is most exposed to what's going on right now in terms of economic and earnings impact, as well as generalized rise in risk premia on European assets. People are very concerned about, the direct impact of the invasion on commodity prices feed through to growth and earnings.
Right, thanks, that makes sense. Switching tact now, have you considered a more aggressive approach to reducing the discount on the share price?
Yeah, very, very good question. So as I said, we bought 9.9 million shares, which is a reasonable chunk, clearly last year, and that's between 1.5% and 2% of outstanding shares which were purchased last year. Our sense, well, firstly, we buy back shares when we're trading at a material discount in normal market conditions, and we'll continue to do so for the reasons I outlined, it as it's accretive to NAV. Our sense is that the share register is relatively in balance, and we saw that by the fact that we were trading at a premium not that long ago, actually. And we'll continue to operate a buyback policy in the manner that we have done for shareholders, because it is accretive to NAV. But I don't think it's appropriate to be buying at a time of buying significant shares at a time of financial stress, because essentially that shrinks the company. Is that in the best interest of shareholders long term? So there's a bit of a trade-off there, and I think we try and strike that balance. And I think there was a question which I'll answer now as well, as to what's the impact of share buybacks short and longer term. So as I said, last year that added about 0.1% to overall NAV returns. Over the last 5 years to the end of 2021, share buybacks added 0.3%. And that contrasts with more than 80% return in NAV. So it's been helpful to buy back shares at a discount, but that's in the context of overall returns last year, as I said, in NAV terms of 21.7 and around 83% or thereabouts over the last 5 years.
Oh, great. Now about gearing, who decides on the level of gearing, and what effect does it have on average over annual performance?
Okay, so the level of gearing, the board determine the gearing policy, and we operate within parameters of 0 to 20% in terms of gearing. I outlined how we've taken on some longer term structural debt, which is fixed rate in nature. So we take those loans out over a very long period of time, have certainty in terms of what we're going to pay. And the board agree. I work very closely with the board in terms of when the right time is and what the structure of the debt should be. But ultimately, the board make the decision as to whether we should be issuing long-term debt and how much and what the overall structure looks like. And I obviously help in that process, but that's a board decision. We have shorter-term debt facilities, what's called a revolving credit facility, that we can just go to a bank and draw down capital. We can draw up to £150 million with 24 hours notice from that facility. We're £50 million drawn today, and I control that and the shorter term gearing levels within parameters agreed by the board. And I make the final point that I obviously have very regular contact with the board in terms of not only tactical but strategic positioning, and therefore discuss gearing levels with them.
Perfect. Gosh, I'm looking at the time. Maybe I'll ask one more. There's been a few about, say, private equity, but in particular, there's one about small cap. Can you explain why there's only 5% allocation to small caps when historically these have outperformed the markets in the long term?
Yeah. Okay. I'm gonna. So why is well we've actually been reducing small cap, and we are likely to reduce it further. And it is true that over very long time periods that small cap has outperformed large cap. However, it's been relatively lumpy in terms of that performance profile. And my sense, and certainly if one looks over, a shorter time period, more recent years, the last decade or so, you can see that's a bit of an anomaly. But there's been an increasing market concentration, and large caps have outperformed small caps, and that's been due to the dominance of a small number of stocks, as I'm sure people are aware. The approach which we are likely to have going forward, and it's partly because I think small caps will be a little bit more tactical in nature going forward. Small cap value, could be an attractive area to invest if we're looking at higher interest rates, higher inflation, but we'll have more of a barbell. So large cap and private equity. I think that smaller companies may struggle to absorb, and this is a very generalized term or a comment, but small caps may have less control actually in terms of input costs than large companies do, and that might be problematic for small cap margins in general. That's a sweeping generalization. And on private equity, we'll focus on the very best venture and growth managers where there's persistence of returns, and then selective mid and smaller company buyouts, mid-market buyouts. And that's a bit of a barbell. So you've got, in the private equity space, venture and growth, best managers, and smaller than small cap, mid-market buyouts will be an area of focus against large cap in the portfolio. And my final point, because I did see it as a question, I know there are a number of questions which I apologize we will not have time to go through, but we do look at private equity returns net of fees, net of all fees, and against public market equivalents. That's really, really important, right? So absolute returns are one thing, but adjusting for what you're paying for exposure and making a like-for-like comparison on a public market equivalent basis is the way that we think about private equity returns and assessing whether it's a good or a bad decision to invest in that area.
Great. And I think we have time just to ask one more question because it is a very topical point about ESG. So Stuart is asking, regarding ESG reporting, do you have plans to identify real carbon reduction versus offsetting? And where it's not available from companies currently, can we use our position, the company's position, like BMO, to push for it to be reported? So that's obviously asking about engagement and whether we're doing enough to really push the underlying companies to improve.
Yeah, it's a really good question, and I probably don't have as crisp and clean an answer as I should for that particular question. What I would say is an area, obviously, of increasing focus. You've highlighted a really important point here as to what is what's real and what's in terms of carbon reduction and what is a continuation of activities against offsetting. It's something I'll take away, and if we get the details of the individual or shareholders who has asked the question, I'll come back to with a more thoughtful answer, because we've got a really large team within BMO and more broadly CTI, more than 20 individuals just on the BMO side focusing on engagement on particularly these issues, so we can come back with a more thoughtful response. But it's something that we're spending a lot of time and attention with in terms of individual company engagement and making sure they're doing the right thing. And it comes back to this point about reporting on whether companies are genuinely aligned or aligning to that net zero goal, or whether there's some smoke and mirrors going on, which I think is implied from the question.
That's great. Christine, Paul, thank you very much indeed for your time this morning. And also thank you to all the investors that have submitted questions today. And of course, we'll make these available to the company. So any further questions that do come in, Christine and Paul will make those available to you. Paul, Christine, I know investor feedback is particularly important to the trust, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, Paul, if I may just ask you for a few closing comments.
Well, look, firstly, I'd like to thank everyone on the call for making the time to attend. I do hope you find it useful. It's obviously a period of tremendous uncertainty. We are clearly pleased with the results that we delivered last year, but very much focused on the continuation of the long record we have in delivering growth in capital and income for shareholders. So thank you again very much for your time, attention and support this morning.
Paul, thank you very much indeed. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the team at F&C Investment Trust, we'd like to thank you very much indeed for attending this morning's presentation. That concludes today's session, and good morning to you all.